Welcome everyone to Dr. Frank's Finance World. I am Dr. Frank, the bank, because I try to teach you things that can make you more money and bank some gains in the future. This topic today is going to be about technical analysis. It's part one of a series. Technical big picture will be part 1 and 2, and then we'll divide some of the more interesting technical analysis techniques into future videos with a series for each. So anyway, please be sure to subscribe if you like what you see. Throughout any of these videos, look in the notes for links and stuff like that. That's where we're going to put them down there to make it easy for you to find, rather than hyperlink in the slide. Check out the books in our bookstore. I read through books and have for years, and I try to give you the best ones for each topic area. And you can get the link there if you wish to purchase those. All right, so the big picture of technical analysis is it's about people. It's about buying and selling patterns and looking for behavioral movements in the market, if you would. As a matter of fact, its history is in behavioral finance, which is saying, why do people do what they do and things like that. So we rely on the behavioral aspect, ultimately with something bigger that's called a regression to the mean. We hope that people get overly excited or overly unhappy with certain securities, stocks, bonds, futures, whatever, and that you can see the shadow of their theories or the theories that they're using to trade in the movements of the prices and the volume and things that they're doing. So a lot of people, I'm a finance professor by trade, they call it voodoo finance for people like me to believe in that. I think about the truth about that is probably 98% of the stuff that comes out on technical analysis is reading tea leaves, voodoo, that kind of stuff. I only stick to the things that I can sort of prove statistically through time. There's many different indicators. A quick look at it, if you run through, just Google it or whatever, you'll see easily 30 or 40 or more. Like I said, the vast majority of them I don't think have any basis in I don't know, facts, statistics, whatever. So I discount those and I don't use those. As a matter of fact, there's about 4 or 5 that we're going to go through. I'm going to focus mostly on the common/math related. It'll be things like Bollinger Bands and relative strength and MACD and Fibonacci and that type stuff. So that's where my background is on all of this. So the history of it, though, actually goes way, way back before computers. Some of the early research I've actually seen on it, they try to denote patterns using X's and O's is how they actually got published. And they call it runs, a movement up and then a movement down and a series of those. But ultimately, it kind of has its basis all the way back to tulip bulbs. You know, the tulip bulb crisis or whatever, the sell-off of that eventually was a giant run-up of people getting specialty type tulip bulbs and saying it was worth more and more just for something that you could get and grow, I guess. But at any rate, that's one of the history of the long looks at people and their behavior along the way. Dow theory, good old Dow, when you see him report every day, and Dow Jones and the business pages and all that, really was also a technical analysis like move where if one went up, you get confirmation from another, but it was based on price and volume and things associated with that. So literally it's been a part of Wall Street for a long, long time, even if people want to try to call it voodoo finance. It does look at the pricing of momentum in a similar way to, we're going to connect this ultimately to anomalies. And, you know, when they first started saying what should impact the price of a stock, all the way back in the 30s, 1930s, 1940s, they were looking at accounting data. That's why the SEC made them report it. And then people started connecting that into the 60s and 70s and so forth. But ultimately, the idea that the market has an impact on the stock was early research in academics, and some of the cracks in the original theory of that was that things like firm size or trading close to book value made a difference too. And so looking at price and volume momentum actually has its history in the anomalies and those type things. I don't consider it voodoo finance. I won't do most of it because I do believe it's like reading tea leaves. There's this head and shoulders formation and blah, blah, blah. And hate me if you want, but I haven't seen a lot of payoff in that long term. And I think it can be very, very subjective. That is the biggest problem with technical analysis and why I stick to the math of what's going on. It all started when I looked at regression and math associated with the normal distribution way back when at Texas Tech when I was going my PhD. But it is applicable, and this is kind of the interesting thing, is it is applicable to many different types of financial assets. You know, you can use it for mutual funds, and you can use it for stocks, and you can use it for bonds, and you can use it for financial futures. Why? Because ultimately, people trading leaves a shadow, and what you're looking at is you're thinking they're going to come back to some long-term average, and therefore when they get out in the tails of the distribution, it's odd, and that means something to buying and selling and so forth. So it is best used in conjunction with more than one measure. In other words, I tried Bollinger Bands. Hold on a second. I tried Bollinger Bands for a bunch of years all by themselves, and that worked okay, but the reality is when you coordinate it with things like relative strength, it actually becomes a lot better as far as an indicator or prediction of what's going to happen next. But if you use more than one, and in every single case, this is what I would suggest to you, do your homework first. This is not a substitute for putting in effort and determining whether this is a good investment or not. The fundamental analysis of what's going on matters. And so make sure you do your fundamental work first, your accounting, and make sure that it's an industry you want to be in, and a firm that's growing and has good products you want to be in, those type of things. Otherwise, all the shadow casting and math in the world isn't going to save you. So basically, a big picture, one of the many ways that people look at the markets. I hear that many mutual funds actually look at this kind of stuff as part of their decision as well. As the market overbought, oversold, that kind of stuff. It does, and this is the interesting thing. You know, when you look at, everybody says market efficiency, and you go out there and it says buy an index because you can't do any better. That is presuming that the market is efficient. There's a lot of case studies and things that say, not all the time, and we will ultimately review some of those as well. But this specifically presumes the markets are inefficient. That at some point in time, you can look at what's going out there and predictively say, odds are, and remember, I think this is very, very important, the market is all about probabilities. It isn't about yay or nay, it's about probabilities. And when it gets to some point in time, probabilistically, it's more likely to go up or more likely to go down, and that's why the math helps. It depends on the price and volume in many cases, although I will say this, I haven't found volume to be a great indicator for me. When you look at relative strength, it sort of looks at up and down movements, but not necessarily volume. I've tried many different ways of transforming volume and putting it into the math, and it doesn't help. The question always with technical analysis is it too subjective? Are you using it to prove what you think you already know, therefore you have biases involved, or not? That's once again why I stick typically to the math, because I think the number one success thing for somebody in investing is discipline. And I'll keep that alone and keep that going out there. It is not a standalone strategy. No one indicator works well by itself. And the question always is, will history repeat itself? The good news is kinda. The bad news is not always. So there are literally hundreds of different indicators, and of course we're looking for those turn points, right? The tops or the bottoms, so we can get in or get out or buy puts or calls or whatever. And the question always is, could it be luck? You know, I've done some research on that through time too, to say, could it be luck that the combination of relative strength and Bollinger Bands helps improve your odds, sometimes significantly, of the times to hold and so forth? It could be. You know, I think it was Warren Buffett who said that if you put enough monkeys in a room, eventually one of them would come up and type Shakespeare's entire works just by random luck. And so that's possible as well. But in general, I don't think so, and I'll show you why. And it is the persistence of the indicators that it works again and again and again in different time frames, I might add. So there's hope for you day traders out there. But there is some persistence of it. It just has to be good enough through time to make money economically. The good news, it can be helpful, particularly in volatile markets and with volatile stocks. The bad news, those traders making it work might change. I believe that certain people get in and out. A good example would be meme stocks at different points in time, and they have a perspective, and when they decide to give up and move on, the people who've been trading in it and kind of making the indicator work, or at least work better, are gone, and it leaves kind of a hole out there. So anyway, I think it does change a little through time. It's something to keep an eye on. And this is true. You may go extended periods of time where they don't work. Recently, when the market was moving up, we had to say, okay, we're not going to get out at the top and in at the bottom based on Bollinger Bands and relative strength. We're going to get out at the top and partway in at the midpoint, and then out at the top and partway at the midpoint, and ride the upward momentum, because this melting up and melting down of markets, technical analysis will not work. The only thing that will save you there is buy and hold. Okay, the books I would suggest for this area, I try to keep these videos short for purpose, but the books I would suggest out there is William O'Neill, the guy who created Investors Business Daily, had a really good book out there on how to make money in stocks. That's a good sort of technical analysis look at it out there. Jack Schwager here has Getting Started in Technical Analysis. That's another good book. Just it gives a wide breadth of what's going on out there. The other thing I like to do is say, what does research say? So let's go see what research says. If you follow this link right here, and you drop it into Google and go there, it's actually going to take you to an academic paper that says why technical analysis doesn't work. Here's a guy, Real Ken, he's been at it for 40 years, and he talks about it out there, but basically, he says that a lot of the people who use technical analysis use it to confirm what they already thought, and that's why it works. Look, it had a support level here, and it will have a support level there again, and that's not really what it's after, I don't think. It's a trading tool employed to evaluate securities and attempt to forecast their future movement by analyzing statistics gathered from trading activities such as price movement and volume. That is, and I do believe that to some degree they do ride within these channels or these bands. It actually looks like this when you do it out there, but high towards the top band, low towards the bottom band and stuff. But the bands are not stagnant. They move with a moving average through time, which is once again why the math matters. What moving average do you use? We'll actually talk about different ones I've done research on when we get to Bollinger Bands and relative strength. So the problem is twofold: data mining bias, the idea that people are looking for a technical indicator that sort of confirms what their trading sense or see the pants is anyway, and then subjective interpretation of the data. It's kind of hard to subjectively interpret math, which is why I stick with math on most of these. And he goes through here and talks about the data mining problem and the subjective interpretation and so forth out there and what that leads to. Anyway, the CFA Institute, which is pretty one of the top brainiac parts of finance, says, like other analytical tools, technical analysis employs a disciplined, systematic approach that seeks to minimize the impact of behavioral biases and emotion from the practice of investment selection. So in theory, if you use the discipline of it, it's a tool to help you get in and out when maybe you should. Anyway, so the usefulness of it, I think it's a pretty useful tool. I use it in my investing. I use it in investing of other people's money I help invest. I used it when I was working at the student managed funds at a couple of different universities I've been at, and it helped us quite a bit. Actually, one of them, 2 universities ago, when I worked with their team of students and real money, they were actually investing, finished first in the country using some of these tools, if you will. And eventually I will create a series on exactly what we did there. So if you choose to repeat what we did, it'll at least give you some information to think about. So anywho, so that being said, what is the strategy or tip? I will always do it this way when I'm going through different topics. And the strategy here is to layer them. Use relative strength and Bollinger Band, for instance, are 2 of the better ones that I've found through time. So don't forget to send email, Dr. Frank's Finance World at gmail.com out there. You'll see the link down below. And don't forget to sign up for notifications if you want to see new videos in the future. So that's part 1 of technical analysis. Part 2 is coming next. See you later.